Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how the yield curve impacts your investments and the economy. The yield curve is a fundamental concept in the world of finance, but its implications reach far beyond just numbers on a chart. Understanding the yield curve is crucial for investors, economists, and anyone with a stake in the financial market. But what exactly is the yield curve, and why does it matter? In simple terms, the yield curve is a graphical representation of the relationship between the interest rates and the time to maturity of debt securities issued by the government. It helps investors and analysts gauge the state of the economy, predict future interest rates, and assess overall market conditions. By examining the shape and movements of the yield curve, investors can glean insights into potential economic developments, such as recessions or inflation. Changes in the yield curve can influence borrowing costs, investment strategies, and even the stock market, making it a vital indicator for decision-making in the financial realm. Understanding the yield curve empowers individuals to make informed choices regarding their investments and financial well-being. In this video, we will delve deeper into the effects of the yield curve on economic indicators and investment decisions. We will explore how shifts in the yield curve impact various sectors of the economy, shedding light on its significance in the financial landscape. Whether you're a seasoned investor or a newcomer to the world of finance, grasping the dynamics of the yield curve is key to navigating the ever-changing waters of the market. So, let's embark on this journey together and unravel the mysteries of the yield curve. Understanding the yield curve. The yield curve is a critical economic indicator that showcases the relationship between bond yields and their maturities, typically plotted on a graph. Understanding the yield curve is vital for investors and economists as it provides insights into future economic conditions and sentiment within financial markets. Normal yield curve. A normal yield curve usually signifies a healthy economy, where short-term bond yields are lower than long-term bond yields. This pattern reflects the expectation of increasing interest rates over time due to anticipated economic growth. Historical data often shows that a normal yield curve is associated with periods of robust economic expansion, where businesses thrive, and consumer confidence is high. On the graph, the normal yield curve slopes upwards, demonstrating the positive correlation between longer-term investments and higher returns. Investors tend to view a normal yield curve favorably, as it indicates stability and growth potential in the economy. Inverted yield curve. Conversely, an inverted yield curve occurs when short-term bond yields surpass long-term bond yields. This inversion is a powerful predictor of an impending recession, historically preceding economic downturns. Investors closely monitor this signal as it suggests uncertainty and potential financial instability. The inverted yield curve reflects investor pessimism about the economy's future, leading to adjustments in investment strategies. During this period, investors may shift towards safer assets, anticipating a downturn in the market. Flat yield curve. A flat yield curve occurs when there is minimal difference between short-term and long-term bond yields, signaling uncertainty in the market. This scenario suggests that investors have limited confidence in future economic conditions, potentially leading to decreased borrowing and investment activities. With a flat yield curve, borrowing costs may remain relatively stable, impacting consumer spending and investment behavior. Investors may adopt a cautious approach, considering the possibility of economic challenges ahead, which could influence market volatility. Understanding the nuances of the yield curve, including its normal, inverted, and flat variations, is crucial for investors to make informed decisions based on prevailing economic conditions and market sentiments. By analyzing these yield curve patterns, investors can adapt their strategies to navigate potential risks and opportunities in the financial landscape. Impact of yield curve on economy and markets. The yield curve plays a significant role in shaping economic and market dynamics. Let's delve into how the yield curve impacts various aspects of the economy and financial markets. Interest rates and yield curve. The relationship between interest rates and the yield curve is crucial in understanding monetary policy decisions. When the yield curve steepens or flattens, it signals shifts in interest rates. For instance, an inverted yield curve, where short-term interest rates are higher than long-term rates, often precedes economic downturns. Policymakers use these signals to adjust interest rates to stimulate or cool down economic activities. This, in turn, influences mortgage rates and borrowing costs for consumers and businesses. Lending and investment decisions. Banks' lending practices and investment strategies are heavily influenced by the shape of the yield curve. A steep yield curve tends to encourage lending as banks can profit from borrowing at lower short-term rates and lending at higher long-term rates. On the other hand, a flat or inverted yield curve may deter lending activities due to lower profit margins. Moreover, movements in the yield curve affect corporate borrowing decisions and capital expenditure planning, impacting overall economic growth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.